Hello and welcome back to our trader training video series. On this short video we're going to look at something that we've touched on already a few times on different videos, and we're going to look at probability distribution. It sounds quite fancy, but the reality is that this probability distribution is essentially the expectation that something will happen. And this bell curve gives a visual representation for, if we think about the absolute peak here, that's the most common thing to happen. And then down the curves on either side, it gives us varying degrees of expectation that something will happen or that something has happened. Now, if we put an example onto this, it might make more sense. If we were to be looking at the number or measuring the height of people, we're saying that the most common height of someone would be at the peak of this bell curve. We're also saying that the majority of people who have their height measured would fall either above or below the most common height by 34%. So we're saying that if we add those two percentages together, 68% of the time we have this range of what people have accepted as normal distribution, and this is all inside one standard deviation. I'm just going to call it SD for short. One standard deviation. So we know that 68% of the time that is what is considered normal. And then on top of that we have this additional measurement. If we go further out, we're saying that 95% of the time, which again is what we've covered on a previous video, 95% of the time price remained within two standard deviations. I'm just going to call it SD for short again, two standard deviations. So what this helps, again I'm just approximating so we can kind of keep it simple, but what this helps us to do is to figure out what's normal and what's not normal, what's at an extreme of being normal and what's not at an extreme of being normal. So if we put a normal range of movements, we can start to think about what our expectation for a stock price may or may not be. If we take this one step further though, before we look at the charts, and we think about an example of dice rolling, if we think about what normal is and what isn't normal, the number 7 can be rolled lots of different ways. So this is the most common thing to happen. And we get this sliding scale of what is normal and what is not normal. This likely thing to happen in the center of the bell curve, and the least likely thing to happen is all the way out at the extremities of the bell curve. Because it's not a common thing. There's only one way that the number 2 can be rolled. There's only one way that the number 12 can be rolled. So the likelihood of 12 being rolled is statistically unlikely. It can happen, but because there are more ways for the number 7 to be rolled, the most likely thing to happen is the number 7. So we just do that. 6 next to it and 8 the other side. So what we do know is that 68% of the time a 6, 7 or an 8 would be rolled, and this would be one standard deviation. We've got 68% of the time, 68% of the ways that price can be rolled would give us a 6, 7 or an 8. So with that in mind, if we were a betting man, it would be most probable that one of those 3 numbers would come out if we were to roll 2 dice together, and that is within this one standard deviation. So when we move to the stock market and to assess the fluctuations in price, we get to have this similar measurement, this similar expectation of what price may or may not do. Let's just have a quick look at this. We've already got an indicator on the chart which measures historical volatility, and we've set this to show what we've termed as the Bollinger Bands, and it plots 2 standard deviations from its midpoint. So we know that 95% of the time price remains, or is expected to remain, inside the upper and the lower band, and it takes its measurements off the last 20 days or the last 20 bars, and then it plots this calculation. So this is an example of historical volatility or historical expectations. What we get to do in the options world is we also get to forecast what might happen in the future. So whereas we've already looked at backward looking expectations to try and figure out if we're at a statistical price extreme, we can also look at what might happen in the future. The calculation that we've looked at is partly factored into when we look at options, and we're going to look at this in more detail, but we find this on our trade tab, and we get a lot of statistics which we'll go into in more detail on a later video. But one of the things that we get to do is measure what may or may not happen. To give us a quick visual reference for the moment, let's just add a study, and we can add this formula that projects out what might happen from a time point of view based on what price is expected to do. So what we know is that, what we now see on the chart rather, is this cone. We've just added this upper and lower cone, and this is based on this bell curve that we were just looking at. And what it takes into consideration, it takes into account the volatility, which can be seen down here, which we'll look at on a separate video. But it takes into account the volatility of what might happen in the future based on everything that we know. And then it takes into consideration time and plots this curve out through time. So at any point on the chart, we can say, at its most basic, price will probably stay inside that cone relative to the time on this chart. So if we just go the upper and lower points, based at that point on the chart, we can expect that price will probably be inside the upper and lower line 68% of the time. So if we look at the dates on this, the current date is, as I'm recording this, the 4th of February, and by the 19th of February, there's a 68% probability that price will be below the upper and the lower band here, because that represents 1 standard deviation. So we have that in mind as when we're thinking about how to construct our trading expectations, and that price typically stays inside of this expected curve, again 68% of the time. Then if we're wanting to, let's just say we're at $125 stock, if we wanted to see price go to 140, so a $15 price movement, it's unlikely, it doesn't mean it can't happen, but it's unlikely to happen because it's out of our normal distribution. Again, remember the bell curve and what that represents. This is normal distribution. Price normally does something inside that curve 68% of the time. So when it moves outside of that range, it becomes less and less likely. So armed with that piece of information, wanting to see the stock price fly to the moon, and let's say it goes to $150, is that realistically an expectation that we can really back up and put a trade on? I've got less faith in that. And similarly, if we saw price drop down to $100, I'm not saying it can't happen, but we've got to ask ourselves, is that likely to happen based on the mathematical expectation, this probability distribution? What would be more likely to happen would be small fluctuation in price up or down, because what we do know is that that happens 68% of the time. So armed with this knowledge, we're able to construct realistic trades and have realistic expectations of what might or might not happen. Because certainly trying to, if it was to use a baseball analogy, swing for the fence, that doesn't happen every day. But what does happen every day is price does this fluctuation, this normal price movement. So we can, again to stick with the baseball analogy, we can get to first or second base quite likely and have a reasonable probability and expectation of that happening than trying to swing for the fence on every trade. So with that in mind, this is going to help us determine what we do and how we do it when we think about the best way to put a trade on. And that's what we're going to explore over the next several videos, is how to interpret the data that's in front of us and that we have available to us, so that we can construct a sensible trade with a sensible outcome and a sensible expectation that we will be able to make money, well, 68% of the time.